Companies Act. A special presentation by The Firm.
Auditors, they will now be rotated. Accounts will now have to be consolidated even for unlisted companies. And in the case of fraud, the liability may lie not just on the offending partner, but also the firm. Hello and welcome to Companies Act. Today and for the next few weeks, we are going to focus on Chapter 9, that's Accounts, and Chapter 10, that's Audit and Auditors. And to do that, I'm joined by Seshagiri Rao, Joint MD and Group CFO at JSW Steel, Santhana Krishnan, well-known auditor, partner at PKF, and an ICAI veteran, PR Ramesh, the chairman of Deloitte India, and Jamil Khatri, global head of accounting advisory services at KPMG. Gentlemen, to all four of you, a warm welcome. Let's begin with the battle of differing definitions. Accounting standards define an associate as one over which the reporting party has significant influence, but which is neither a subsidiary nor a joint venture. The Companies Act 2013 goes 2 steps further to define significant influence as control of at least 20% of total share capital or of business decisions, and it includes joint ventures among associates. Now to the subsidiary confusion. Accounting standards define a subsidiary as one in which the holding company owns more than 50% of equity share capital or controls the composition of the board. The Companies Act 2013 definition looks the same but is very different, because the Companies Act definition refers not to equity share capital but to total share capital, and total share capital includes convertible preference shares as well.
There is a serious implication, because when you are preparing financial statements, you can only prepare them in accordance with accounting standards. Right. I do concede that the rules provide that they shall be consolidated in accordance with accounting standards. The definition of subsidiary and associate is different in accounting standards, definitely the definition of subsidiary. And so effectively, you are consolidating a set of entities which are not necessarily subsidiaries under the Companies Act, or the reverse, you are not consolidating certain entities which are subsidiaries under the Companies Act definition. It further compounds the problem, because director's report discusses subsidiaries. So if you have a situation where you have added together 5 entities and prepared consolidated financial statements, and you have to discuss the results, if the director's report is to cover subsidiaries under the Companies Act, you may be discussing 7 entities instead of 5, or 3 entities instead of 5. So whilst for regulating entities it may be important to determine what are subsidiaries, but I think it should just stop there. For all other purposes, the definition should be in accounting standards, because accounting standards are dynamic and the definitions are changing as international definitions change.
I think the key point is to clearly lay out that the definition of subsidiary under the Companies Act is relevant for the purposes of compliance with the provisions of the Companies Act, other than preparation of the financial statements.
I may not agree, because the accounts will have to be prepared in accordance with the Act, and the Act says in accordance with the accounting standard. There is a regulatory requirement that subsidiary definition for regulatory purposes is one, which is different from the accounting standard. These regulatory accounts will have to be filed in accordance with the audit report and also to the regulator. Therefore, the financial statements will have to come only in accordance with the Act. If there is a difference between the Act and the standard, I think the Act should override the standard. That is what we have also spelled out. So you have to prepare.
In simple English, if a subsidiary is a subsidiary under the Act but not a subsidiary under accounting standards, it will still have to be considered a subsidiary when preparing accounts and consolidating them, etc., under the Act. Is that the simplest way to understand
Under the Act,
that?
it has to be consolidated.
The Act overrides as far as accounting standards are concerned, or any other regulations are concerned. So we have to follow the Act to comply with the requirement.
It's easier said than done. If it becomes a subsidiary because of preference capital holding, preference capital is in substance debt. Even when you apply the accounting rules on consolidation, essentially you are coming up with the entire assets being part of
How do you resolve it? I get the problem, Jalbreed. How do you resolve this?
I think the way to resolve it, and I don't necessarily agree with the view that the accounting standards in all cases are subordinate to the Companies Act, because if the accounting standards are notified under the same act, which is what the plan is for AS21 to be notified, they become as much a part of the act as anything else.
Okay.
And I think there is a fair argument to kind of say that for the purpose of the financial statements, the accounting standard definition will apply. Of course, it will be in everybody's interest for the government to clarify this, because there is no fun out of having these different definitions.
Right.
In fact, this was discussed at the ministry level, at the rulemaking committee level. Very clearly, government wanted to define total capital, and it said preference share capital to be. The reason for regulatory intervention here is there are several people who are keeping a huge preference capital, small equity capital. Therefore, they were able to play around without consolidation.
Right.
Now, the law is supposed to bring in some kind of uniformity into people. When they don't follow a law, they get stricter and define it. It was a clear definition discussion, said it should be defined as total capital. But the total capital poses a lot of problem. If you include preference, then when you calculate minority interest, what do you do? It's a problem. But then the problem can be solved only by amending the act. There is no way that people can follow.
What should companies do now, sir, according to you?
It has to go by the Companies Act definition, because the auditor's report is to say, is it in accordance with the Act? And then only accounting standards. So the Act will always override the standards. And government has also written to the Institute to say bring harmony between both. Yeah. So probable, highly probable that the accounting standard may undergo a change. Wherever the standard has got a different definition from the Act, they may say that the standard will say that definition will prevail. There is a project that is going on in the ASB, which we have commenced on bringing harmony between both.
I think the problem gets compounded, if you ask me, Menka, because I think if the whole idea of this act was to move forward our reporting and governance towards international norms, this is pushing us back 2 steps backwards. Because consolidating a subsidiary based on preference capital is not the right way to go. There are many examples where, SK rightly made the point on this was an anti-abuse provision. Think about a private equity funding. You have a company where 100% of the equity is held by a sponsoring company, rightfully should be consolidated. They get convertible preference capital into this company. Suddenly, it's no longer a subsidiary because the preference capital is many-fold the value at which equity was put in. That cannot be the intention of any financial statements, is the way I see it.
Companies Act, a special presentation by The Firm.
The Companies Act 2013 mandates every company to have a financial year ending March 31st. Exceptions can be made for a holding company or subsidiary of a company incorporated outside India. The transition time provided for compliance is 2 years starting April 1st, 2014. The new law also requires, for the first time again, that all companies, including unlisted and private companies with one or more subsidiary, associate or joint venture company, must prepare consolidated financial statements.
Industry point of view, only one point which I have as far as the 31st March date is alignment is concerned. If a company is having a subsidiary overseas and that subsidiary as per the local law, it has to have different accounting year, then there is a provision to get exemption by going to the tribunal. But at the same time, if I have a joint venture, then that joint venture there is no exemption provided in case the local law says it has to be a different accounting year. So the exemption is not possible. So then it cannot be aligned as far as the accounting year of a joint venture which is outside India with the parent company. That is one problem which I am seeing. There is no answer which I am seeing right now as per the Act. The second point as far as the consolidation of various subsidiaries and joint ventures are concerned. The major challenge is, one is the consolidation at the intermediate level. That is one major challenge which the industry is facing. Number 2 is the disclosure of every subsidiary performance in the director's report. That is also become very voluminous, particularly very, very small companies when compared to the parent company's turnover or profitability, not material or insignificant. Even then, every subsidiary's performance is to be debated and discussed and given in the director's report. I think this is a major compliance problem which is industry is facing.
Okay, fine. Let's take up both the points that Mr. Rao has raised. First, sir, the joint venture point. Can you throw some light on how you would interpret this?
It's
What
an
do you do
issue
with
that
this?
we'll have to get clarification from the ministry.
Okay.
It may not be a clarification. They may have to go for an amendment, or there is a section which is called as removal of difficulties.
Yes,
they may have to invoke the difficulty section and exempt it. Otherwise, what he says is right, and that problem will persist.
Essentially, it means preparing 2 sets of financial statements on 2 different dates and getting them audited. So it's an operational issue. It's a cost versus benefit issue in a way.
Jamil, consolidating that?
I tend to agree, because even today there are many cases where your foreign subsidiaries have a different year end, and companies, either based on materiality or other considerations, take a view on how you need to incorporate their results. The accounting standards permit you to consolidate the results of a associate using a different year end, and I think that's the approach you'll have to take out here.
The quicker remedy would be invoking the provisions of 470.
In yet another first, the Companies Act 2013 provides for the reopening of accounts if an application is made by the government, the tax department, SEBI, or any other regulator, and a court or the NCLT find fraud or mismanagement. A company may voluntarily revise financial statements going back 3 financial years if they are found to be non-compliant with sections 129 and 134. But it needs court approval to do so. All the rules accompanying these provisions are not yet final.
Hitherto, this has not been allowed. So typically, for the first time, we're coming into revision of accounts and going retrospectively. This will certainly lead to, it just can't be only because of a change in law. It could be because of change in facts, change in perception. Anything could trigger a revision. If that revision is done, then there are going to be, if there is a board level change, there is an auditor change, all this will pose enormous problems. And courts may not be able to come and adjudicate and say, yes, this revision is right, because there will be difference of opinion. And people could misuse this provision for revision of accounts for various reasons. Supposing an acquisition has taken place, they find they paid a huge price, and they will have to put the blame on somebody and reduce the price considerations, or take a view on the asset values. They may use this as a good legal method to revise the accounts. I think this will throw up a lot of legal challenges.
Yeah, it could have been on a pro forma basis more than actually mandating making of an adjustment, as he rightly said.
No, voluntary revision of accounts or revision of accounts has been permitted in the Act, only to ensure that in case there is a fraud that has been identified by any of the regulatory agency, thereby they can direct to revise the accounts. That is the purpose.
I'll tell you one other difficulty, and which is a serious difficulty, is when you go back and reopen each of the past year's accounts, it's quite likely that the auditor in that year could have been different. Now you may be reopening the account for a specific fraud or an accounting adjustment. This current auditor will not be able to express an opinion on those financial statements because he has not audited the entire financial statements. He only is familiar with this adjustment. There could be much more there, cut-off issues. So that's why I'm saying the restatement on a pro forma basis is easier. Whilst you can prepare financial statements to give effect to these adjustments, getting an audit opinion is extremely difficult.
Another example, Ramesh, is on the intangible assets. Somebody could have taken a view that intangible asset will come for 50 years. Suddenly, 3 years later, we may realize this particular intangible asset has lost its value because of various reasons. Now, you go back and adjust your depreciation for the past years. It will be extremely difficult.
I think for me, this is fear of the unknown. This is not something which is unique. I mean, globally, restatement of accounts is very common. Some of the issues that SK mentioned again are real issues, but all of them have been dealt with one way or the other.
Okay.
I find it very difficult from a true and fair view to take the entire, and you mentioned Satyam as an example, taking the entire effect in 1 year as a single prior period item. I always find it better to go back and change the previous period and show it in a particular manner. Does it throw up challenges around dividend distribution? Yes, it does. Does it throw up challenges around taxation? It does. Challenges around who's going to go back and audit it? I think those are real challenges. But I think it is a fair presentation if you go back and adjust these errors, fraud, differences, whatever you may call it in the respective periods. I think it's only going to reflect in a better presentation of the financial statement.
I suppose it's easier
for
for
income tax act, revised return can be filed only for 2 years. So if you have to open the account more than 2 years,
years.
then there is a problem under income tax.
All I'm
Ramesh
saying
had a
is that
solution for
purpose is served by pro forma presentation.
Correct. Ramesh,
After all, you want to give what would the picture look like if these were adjusted. That's all.
Yeah.
Without going into the next steps of getting an opinion on those and all of it, which is enormous.
Companies Act, a special presentation by The Firm.
The Companies Act 2013 is big on disclosures, and Section 134 is a shining example. Compared to the 1956 Act, the 2013 Act requires many more disclosures in the board report, such as appointment and remuneration policies, explanation on every adverse remark made in the audit and the secretarial audit, intercorporate loans and investments, related party transactions, the risk management policy, CSR policy, board performance evaluation, and a separate section with a report on the performance and financial position of each subsidiary, associate, and joint venture included in the consolidated financial statement. The director's responsibility statement in the board report now requires directors of a listed company to state that they have laid down adequate internal financial controls that are operating effectively. Internal financial controls have been defined widely to include policies for ensuring orderly and efficient conduct of business, safeguarding of assets, and prevention and detection of fraud. The rules attempt to narrow the scope of internal financial controls by linking them to financial statements, but they are not limited to listed companies.
The director's responsibility statement, which now extends the scope where they have to take additional responsibilities, particularly relating to internal financial controls. I think on that, of course, they have to rely on the audit committee to give the comfort that there are adequate internal financial controls in the system. And in order to ensure for the audit committee to do, they can also now take the help of external agencies if required. I think the setting those systems and getting comfort every time that there are enough controls in place, not only in ensuring that relating to finance, relating to business effectiveness, operating effectiveness. I think there the challenges will be there as far as disclosing that in the director's responsibility statement, in my view.
Okay, add it to the bit on all the subsidiary disclosures that are required, which will make the director's statement a voluminous statement.
Accounts.
Yeah, fair enough. Internal financial controls. Why is this such a sticky area?
Again, several reasons. One is what the law does not stipulate. I'm sure guidance will come from the Institute of Chartered Accountants, hopefully. Is what should be the framework? Should it be the COSO framework? Should it be the Canadian Institute's guidance? Should it be the England and Wales Institute guidance? There are multiple frameworks. Second is, the intent was in financial controls over financial reporting. But the way the law has defined it is internal financial controls, and it talks of even orderly and efficient conduct of the business.
Yeah.
That is too sweeping to expect both directors to be able to put that in place and operating effectiveness, and auditors to report thereon. So I think it's more to do with the definition and what is the import of it. And there is a third element which always one asks, and this was also raised in the context of Sarbanes-Oxley, is what is it commensurate with the benefit you're trying to derive from it? I think we should restrict it to internal control over financial reporting, ICFR, which is what is done internationally.
You have to segregate them into two, on the board report and the auditor's report. To the extent of auditor's report, we have dealt with in the rule to say that it is only with reference to financial reporting. You will go through the rules. We have specifically discussed it and introduced it. To the extent of board, things will settle down over a period of 1 or 2 years. But are we saying that the directors were not responsible for this? Why? I mean, I don't understand why people should be so worried about it. If directors were responsible for the conduct of the business, now all that directors are required to say is, please state so in the director's responsibility statement. Now, because it has come in the statement, directors are saying, why don't you document it? Now, is documenting an existing control, is it such a serious issue that people should get worked up? I don't agree.
No, it boils down to the rigor. And if you're applying a COSO framework, and you get into documenting all of the controls in that way, it's a huge exercise.
They've not said that in the rule. They've not said in the Act.
No,
the
you've
rules.
not. But that's exactly the point I'm making is what is the rigor, and that needs clarity. And one more dimension, Jamil, is does this also apply to consolidated financial statements, including the auditor's report? That clarity is not there. So if you're extending that dimension across the world, then including the auditor's reporting, that's a completely
Probably after
different.
you, I'll take a.
I think I think the practical problem is if you have independent directors, particularly directors who are not involved in the day-to-day operations of the company, and they have to certify something or in the board report, then they would like a higher level of documentation, and that's where the challenge
Because
comes
where
from.
else are they going to get the comfort from?
So I agree, and therefore what board of directors would insist on rightfully is to say not only do you in substance say that there is an internal financial control, but how do you document it, how do you test it so that we have evidence of giving our assertion, and that's where the build-up of efforts kind of happens, which results in cost, and that's the question around cost versus benefit. So my own experience is that boards will insist on a lot more rigor, a lot more documentation and testing before they include this in the board responsibilities.
It leads you to better governance.
Better governance or more paperwork, Mr. Rao? Be honest.
It is definitely better governance in my view, because earlier it used to be a process which is to be robust enough to ensure that the internal controls are adequately in place. Whereas today what is being expected to certify by way of a director's responsibility statement, every item which is coming in the P&L account and balance sheet and cash flow, in order to enter into that statement, all the processes, everything is perfect, number one. Efficiency of doing the business is also to be certified by director's responsibility statement. So that is where the problem in my view lies. How do you ensure that the business is done efficiently? There is always a subjective view on that.
Right.
So for instance, if we have to place an order on a supplier, so have we followed the entire process properly or not? Have we procured this item in the most efficient manner or not? Am I running my plant and machinery in the most efficient manner or not? This is
the most efficient would be e-auctions for all, you know. And then you say,
Are you not still doing it?
Anything can be questioned.
Is it not today a responsibility of the director? If the answer to that is yes, then we can't object to this. If the answer to that is no, saying no, it's not my responsibility, all that the people are saying is please put your signature to your responsibility. If orderly and efficiently running a business was the board's responsibility, if it is not, then who else? The whole idea is stakeholders should know who is responsible. I think for a while this can create problem, it will settle down over a period of 1 or 2 years. Maybe we'll dilute some of the provisions. But I don't think this can be said, this is too much of paperwork, don't do it.
No, the responsibility of the board of directors earlier was the same as that of today. But you have introduced something else to certify and give a certificate to the shareholder.
They only said put your signature.
So at that time, whoever is now made to be known that this is additionally you have to do, then he wants a comfort for which there is a compliance work, there is a cost.
I agree. That's
so
why
today particularly the companies which have to incur, where larger operations are there, they have to incur more.
That's one
Small
of the reasons,
companies cannot afford to
So
do
that's
that.
one of the reasons why they increase the sitting fee to 1 lakh, sir.
Next week, the even more contentious issue of audit rotation.
Companies Act, a special presentation by The Firm.